Hi, and welcome to this week's look at the biggest stories to have impacted the markets so far. And we're actually going to start on a bit of a down note, a bit of a blue note, and that's the Monday morning blues for the UK economy. There's been lots of talk of recession over the last 12 months. Obviously, we've had the lockdown effect, low production from the bigger firms, small businesses going out of business, global supply chain disruption. On top of that, energy prices have been going through the roof, as we all know, and we're suffering from quite severe levels of inflation. Now, these are all contributory factors, and these are one of the main reasons that we've been talking about a recession coming to the UK, to Europe, and even the US. But it's not quite arrived yet. Obviously, there's a very tough cost of living crisis going on. But the fact it's not quite materialised as yet, and in fact we're looking at the US stating that things may not be as bad as we were perceiving just a few months ago, and the EU coming out this week and saying it perhaps won't be as bad as we first thought. The UK is in a different situation. Ernst & Young have grave concerns that the fact it's not materialised yet means that when it does hit, it could well be very severe. They're talking about obviously a decrease in government support, increasing taxes, and a gloomy outlook, all playing major roles in this. And they've said that UK GDP could drop 0.75% this year. It may, they say, increase in the following years, but that obviously is a bit of a concern. Now, sterling fell against the euro after this statements were made, but remains stable against the US dollar. Why might that be? Well, the FTSE 100 has had a good few weeks, there's no doubt about it. It's pretty much rocketed. So are we seeing that blue chip stocks in the UK are seen as a relief from some of the US tech stock volatility that we've seen? Now, UK blue chip stocks tend to be old school stocks, low tech stocks. So they're being seen as a little bit of safe haven away from volatility. So the UK 100 is doing okay, but this outlook from Ernst & Young is troublesome, and I think it's fair to say we are going to be looking at a recession very soon in the UK. Second up, we're going to have a look at something perhaps a little bit more positive, particularly for energy consumers. Maybe not if you're holding long positions, obviously, but natural gas, US natural gas, has fallen 50% in just 1 month. In mid-December last year, 2022, natural gas futures on the New York Exchange was $6.8. Mid-January, that was down to $3.4. In fact, last Friday, it fell to $3.1. And now we're currently below $3 for the first time since May 2021. Well, what's caused this sudden fall? Well, we have had a mild winter in Europe and the US, despite some major weather events, obviously. Overall, not as cold as was feared. And the reduction of gas supplies from Russia to Europe is no longer having a bullish effect on the prices. So, good news. What's going to happen next? Well, we may find support near the parallel channel line. That's number 1 on the chart, although we are now below the $3, as I've mentioned. Volumes decrease, that's number 2 on the chart, as the price decreases. Now, this could be interpreted as a shortage of supply and sellers unwilling to receive so little for their natural gas. We saw a bullish gap on Monday morning, which could indicate that demand is returning. However, we are still below $3, with production increases in the US and domestic supply boosted by a quite severe long outage at an LNG export plant, according to Bloomberg, have also helped this price decrease. What's going to happen coming up? Who knows? Obviously, geopolitical concerns are still there, but could this be the end of the severe worry about how high energy prices will get? Well, we're going to have to wait and see. Video 3, we're going to look at how big tech woes have led to layoffs in employment. However, stocks have surged since then. Now, I mentioned earlier that, we're seeing the UK 100, for example, doing well. Is that a result of people coming out of big tech stocks in the US? Well, they have been taking a bit of a beating recently over the last 12 months, and the chart pattern for NASDAQ doesn't give us a great look. These European stock markets, the more traditional stocks, look to have benefited without a shadow of a doubt. Alphabet, now that's the owner of Google, last week announced redundancies, and more companies in that sector have followed suit. But prices have benefited from these layoffs. Now, Alphabet was up 5% last week after 12,000 people stated to be laid off. That's approximately $50 billion increase in market value. Meta, Facebook, has increased 50% since the announcement of redundancies last November. That was 11,000 jobs to be lost. Now, Silicon Valley notoriously has a reputation for being bloated and having many high-paid staff. Have a lot of these companies overexpanded due to the e-commerce revolution caused by the COVID lockdowns that we saw back in 2020? Do they jump on that bandwagon a little bit too overzealously? Well, certainly the tables seem to be turning, and a return, or in fact a change to the more traditional values of keeping shareholders happy could well be one of these drivers. I think investors are thinking, okay, we're getting rid of a lot of fat around the meat. It's no guarantee that the recovery will continue, and tech stocks have been very volatile for the last 12 months. So if you're looking at this area of the market, don't forget your risk management techniques. Okay, finally for this week, and we're going to stick with, is it a tech stock? Is it an automotive maker? We're going to stick in the US and looking at a particular equity, and that's Tesla's report that came out this week. Pretty much unavoidable. I'm sure you've seen these results yourself. It's plastered everywhere. Tesla was one of the main victims of the 2022 bear market. It fell 73% in 12 months. There are many reasons for that, not least, obviously, Elon Musk's acquisition of Twitter and concerns about that. Now, the report that came out could have had one of two outcomes. Firstly, could confirm the recovery of the shares in 2023, currently up about 38% year to date. Or, secondly, it could give more momentum to the bears. So what actually happened? Well, it's scenario one, quite honestly, confirming recovery, it certainly appears to, of the shares in 2023. They're up 5% in the aftermarket after the figures came out. But why? What were the main highlights of these figures? Well, Tesla delivered more than 1.3 million vehicles in 2022, with a margin of 17%. Well, that's the highest in their industry, no doubts about it. January saw the highest level of year-to-date bookings ever, and currently orders are running about twice the volume of production. On top of this, they also announced that they reduced costs. All in all, pretty good soundings coming out from them. And Elon Musk himself said that Twitter's not a problem, but an opportunity for Tesla to sell more vehicles. Have a quick look at a chart. It shows a bullish reversal since the high volumes of December. That's marked 1. Was that large investors buying up what they considered to be cheap stock? Now, 105 to the 120 zone highlighted in green could become a support trend line. Also, though, point 2, that trend line could call the rally. But I think certainly there's been a lot of confidence taken based off of these figures. Where does it go from here? Well, we know it's one of the most talked about companies in the world. We know obviously it has a large figurehead, shall we say. So there's lots of factors come into play when it comes to Tesla, but certainly the report seems to back the fact that it's on the road to recovery. That's it for this week. Wish you luck for your trading in the week ahead. Bye for now.